Hey everyone, today we will learn about the basics of economy for UPSC and other government exams in brief.
The bank rate, the rate at which the central bank lends money to commercial banks. For example, if the bank rate is high, borrowing becomes expensive. A repo rate, the rate at which the central bank lends money to commercial banks with a repurchase agreement. This means that commercial banks borrow funds from the central bank with the promise to repurchase the securities at a later date. For example, a lower repo rate can increase liquidity in the market by making borrowing cheaper for banks. This, in turn, can lead to more loans being available for businesses. Reverse repo rate, the rate at which the central bank borrows money from commercial banks. For example, a higher reverse repo rate can reduce liquidity in the market. MSF, a facility for banks to borrow overnight funds from the central bank. For example, banks use MSF to meet short-term liquidity mismatches. LAF, a tool used by the central bank to manage liquidity and control short-term interest rates. For example, LAF includes repo and reverse repo operations. SLR, or Statutory Liquidity Ratio, is the percentage of net demand and time liabilities that banks are required to maintain in the form of liquid assets, such as cash, gold, or government-approved securities like government bonds. This ratio is crucial for ensuring the bank's liquidity and financial stability. For example, a higher SLR restricts the bank's ability to lend more money, as it has to keep a larger portion of its deposits in reserve, thereby controlling inflation and ensuring economics. CRR, or Cash Reserve Ratio, is the percentage of a bank's total deposits that must be maintained with the central bank. This regulatory measure ensures that banks have a safety net of funds. For example, a higher CRR reduces the amount of funds available for banks to lend, thereby controlling liquidity in the economy. Conversely, a lower CRR increases the lending capacity of banks, stimulating economic activity. This balance is crucial for maintaining financial stability and controlling inflation. Inflation, the rate at which the general level of prices for goods and services rises. For example, high inflation erodes purchasing power. GDP, the total value of goods and services produced within a country. For example, a higher GDP indicates a growing economy. Fiscal deficit, the difference between the government's total expenditure and its total revenue. For example, a high fiscal deficit can lead to increased borrowing. Monetary policy, the process by which the central bank controls the supply of money. For example, the central bank may use interest rates to That's it. Understanding these terms is crucial for UPSC and other government exam aspirants. Like, share, and subscribe for more simple explanations on economic concepts.